Are you curious about how real estate can build long-term wealth but overwhelmed by the technical terms like cash flow and ROI? Wondering what separates successful real estate investors from those who struggle to make ends meet? If you've ever asked yourself, how do I know if a property is a good investment? Or what numbers should I be focusing on? Then you're in the right place. Frank Gallinelli's book holds the key to understanding the essential financial metrics that every real estate investor needs to master. Ready to learn how to evaluate real estate like a pro and make smarter investment decisions? Let's dive in. Chapter 1. Why Cash Flow is King. Imagine you've just bought your first rental property. You've heard people say real estate is the best way to build wealth, and you're excited to watch the property's value increase over time. Maybe you've even daydreamed about flipping this property for a huge profit or selling it in a hot market. But then, a few months go by, and reality starts to sink in. The rent you're receiving barely covers your mortgage payments, and suddenly there are repairs that need immediate attention. A leaky roof here, a broken furnace there, and before you know it, you're losing money instead of making it. This scenario is all too familiar for many first-time real estate investors, and it's exactly why Frank Gallinelli begins his book with a critical lesson. Cash flow is king. You see, while it's easy to get swept up in the excitement of property appreciation, Gallinelli emphasizes that focusing solely on the potential for a property's value to rise can be a dangerous trap. The truth is, appreciation is speculative. It's something that might happen, but there are no guarantees. What happens if the market takes a downturn? What happens if you need to sell during a recession, when property values are at rock bottom? These are questions many investors fail to consider, and it's why they end up disappointed or even bankrupt. Gallinelli wants us to think of cash flow as the lifeblood of any real estate investment. Imagine cash flow as the steady heartbeat that keeps your investment alive and well. Without it, you're constantly scrambling to cover costs, stressed about making mortgage payments, and worrying about the next unexpected repair. But with positive cash flow, you have breathing room. You're not just covering your expenses, you're making money month after month, regardless of whether the property's value goes up or down. In this first chapter, Gallinelli explains why cash flow should be your primary focus as a real estate investor. He makes it clear that while appreciation might be the cherry on top, cash flow is the cake. If you want to succeed in real estate, you need to look beyond the surface and dig into the numbers. And the first number you should always be looking at is net operating income, or NOI. NOI is a simple but powerful metric. It tells you how much money your property is generating after you subtract all your operating expenses from your gross income. Gallinelli walks us through a basic formula. Gross income minus operating expenses equals NOI. This number is crucial because it gives you a clear picture of how much profit or loss your property is actually generating. It's not just about how much rent you're collecting. It's about how much money is left after you've paid for things like property management, taxes, insurance, and maintenance. Gallinelli doesn't just stop there, though. He emphasizes the importance of being realistic about your expenses. It's easy to underestimate costs when you're eager to close a deal, but the most successful investors are those who take a conservative approach. They overestimate their expenses and assume that vacancies, repairs, and unexpected costs will happen, and they plan for them. In other words, they never let their excitement cloud their judgment. As Gallinelli tells us, positive cash flow is not just about making money, it's about reducing risk. Think of it as a safety net that cushions you when things go wrong, whether it's a sudden market downturn or a high vacancy rate. If you're relying solely on appreciation, you're putting yourself at the mercy of the market. But with positive cash flow, you can ride out the storms, knowing that your property is still generating income even in tough times. So, what's the key takeaway from this first chapter? It's simple. Focus on cash flow, not appreciation. Appreciation might be the shiny object that grabs your attention, but it's cash flow that will keep your investment afloat in the long run. Gallinelli sets the stage for the rest of the book by driving home this point. Understanding cash flow is the foundation of real estate success. And once you've grasped this concept, You're ready to move forward and dive deeper into the numbers that will help you evaluate any real estate deal with confidence. Chapter 2. Understanding the numbers, NOI, ROI, and cap rate. Now that Gallinelli has established the importance of cash flow, he takes us deeper into the essential numbers that every real estate investor must understand. If you've ever felt overwhelmed by financial jargon like NOE, ROI, or cap rate, don't worry, this is where it all starts to make sense. Frank Gallinelli does an excellent job of breaking down these terms, not just in a dry textbook way, but in a way that makes you see how each number tells a vital part of the story of your investment. Let's start with net operating income, NOI. In the previous chapter, Gallinelli introduced this as the key metric to evaluate cash flow, but now he digs a little deeper. NOI isn't just a random number, it's the pulse of your property's financial health. When you look at NOI, you're seeing whether your property is profitable or bleeding money. Gallinelli walks us through how to calculate NOI by taking the total gross income, which could be rental income, parking fees, or any other income the property generates, and subtracting all the operating expenses. Operating expenses include things like property management fees, repairs, insurance, and taxes. What you're left with is your NOI, a figure that shows whether your property is generating positive or negative cash flow. But why is NOI so important? It's because this number forms the basis for many of the decisions you'll make as an investor. Gallinelli paints a picture of two investors looking at the same property. One investor sees a beautiful building in a prime location and gets excited about its potential. The other investor pulls out a calculator, figures out the NOI, and realizes that after factoring in all the expenses, the property is barely breaking even. Guess who's more likely to make a smart decision? The investor who focuses on the numbers, not just the property's appearance. This is one of the critical insights Gallinelli offers. In real estate, it's easy to get emotionally attached to a deal, but smart investors let the numbers guide their choices. Next, Gallinelli introduces us to return on investment, ROI. If NOI is about understanding your property's cash flow, ROI is about understanding the return you're getting on the money you've invested. Think of ROI as a way of measuring how hard your money is working for you. The formula is simple. Take the net profit, which could be your NOI or a capital gain from selling the property, and divide it by the total investment cost. This gives you a percentage, and that percentage is your ROI. But Gallinelli doesn't stop at just giving us the formula. He explains that ROI can be a powerful tool for comparing different investment opportunities. Imagine you're looking at two properties. One has a lower purchase price but higher maintenance costs, while the other has a higher price tag but lower ongoing expenses. By calculating the ROI for both properties, you can see which one is likely to give you a better return on your money. This chapter gives you the tools to make these comparisons and take the guesswork out of real estate investing. Finally, Gallinelli introduces capitalization rate, or cap rate. This is another number that often intimidates new investors, but Gallinelli makes it simple. Cap rate is essentially a way to measure the return on an investment property based on the income it generates. It's calculated by taking the NOI and dividing it by the property's purchase price. For example, if a property has an NOI of $10,000 and you bought it for $100,000, the cap rate would be 10%. What makes cap rate useful is that it allows you to compare properties across different markets and price ranges. You might be looking at two properties in different cities with wildly different price tags, but by comparing their cap rates, you can get a sense of which property offers better value. Gallinelli also emphasizes that cap rate isn't just about returns, it's also about risk. A high cap rate might mean a higher return, but it could also indicate higher risk. For example, a property in a less desirable neighborhood might have a higher cap rate because it's harder to keep tenants or the area is more volatile. On the other hand, a property in a stable, high-demand area might have a lower cap rate, but it also comes with lower risk. Gallinelli helps us see that understanding cap rate allows you to balance risk and return, making smarter decisions about where to invest. By the end of this chapter, you begin to see the world of real estate investing through a different lens. It's no longer about flashy properties or gut feelings. It's about the hard numbers that tell the real story. Gallinelli doesn't just hand you the formulas. He shows you how to use them to make informed, data-driven decisions. And as you start to grasp these concepts, you realize that mastering these numbers is what separates successful investors from those who simply hope for the best. Chapter 3. Time Value of Money, the Foundation of Investment Decisions. With a firm grasp of NOI, ROI, and cap rate, Gallinelli now takes us into one of the most critical financial concepts, the time value of money, TVM. This chapter introduces a key principle in both finance and real estate. A dollar today is worth more than a dollar tomorrow. It's a simple idea, but one with profound implications for how you evaluate real estate deals. To explain this concept, Gallinelli asks us to imagine two investment scenarios. In the first scenario, you invest $100,000 today, and in 5 years, that investment grows to $150,000. In the second scenario, you invest the same $100,000, but you don't get your return for 10 years. Even though both scenarios give you the same final amount, the first scenario is more attractive. Why? Because the money you receive sooner can be reinvested, spent, or saved to earn more. This is the essence of the time value of money. Money has the potential to grow over time, so the sooner you have it, the more valuable it is. Gallinelli then introduces us to a couple of key tools for evaluating the time value of money in real estate: discounted cash flow, DCF, and internal rate of return, IRR. Now, before you get intimidated by these terms, Gallinelli does an excellent job of breaking them down into simple, digestible concepts. Discounted cash flow is a method of evaluating how much future cash flows, like rent payments, are worth in today's dollars. Think of it this way. If someone offered you $10,000 in 5 years, you wouldn't consider that the same as receiving $10,000 today. Why? Because over those 5 years, inflation erodes purchasing power, and you miss out on the opportunity to invest that money elsewhere. DCF helps you calculate the present value of those future cash flows, giving you a more accurate picture of an investment's true worth. This concept ties back into real estate when you're evaluating long-term rental income. Let's say you're looking at a property that promises a steady stream of rental income over the next 10 years. Instead of just adding up those future payments, DCF allows you to discount them to reflect their present value. This way, you can make a more informed decision about whether the property is truly worth the investment. Gallinelli also introduces the internal rate of return, IRR, another powerful tool for assessing an investment's profitability. IRR is the rate at which the present value of future cash flows equals the initial investment. In other words, it's the annualized rate of return you can expect to earn from an investment, taking into account the timing of those returns. The higher the IRR, the more attractive the investment. These tools might sound technical, but Gallinelli stresses that they're essential for making smart investment decisions. When you evaluate real estate without considering the time value of money, you risk overestimating future returns and underestimating risk. By using DCF and IRR, you can account for the fact that money loses value over time, ensuring that you're making decisions based on the true worth of an investment. Gallinelli's explanations make these concepts feel accessible and practical. He shows us how understanding the time value of money helps investors see beyond short-term gains and consider the long-term sustainability of their investments. It's not just about how much money you'll make. It's about when you'll make it and how much that money will be worth when you do. As we close out this chapter, one thing becomes clear. Real estate investing isn't just about finding a good deal. It's about understanding the financial mechanics that drive profitability. Whether you're calculating NOI, ROI, cap rate, or DCF, these numbers help you see the bigger picture and make informed decisions that lead to long-term success. Chapter 4. Cash Flow Projections, Forecasting the Future. Now that we've explored the critical financial metrics, Frank Gallinelli shifts the focus to one of the most important aspects of real estate investing: cash flow projections. Imagine this as your investment crystal ball, a tool that lets you peer into the future and estimate whether a property will continue to generate income over time or turn into a financial burden. It's not just about knowing the current cash flow, as we've seen with NOI. It's about forecasting what will happen in the future, and Gallinelli stresses the importance of making these projections with both optimism and caution. Cash flow projections are essentially a roadmap for your investment. You're not just looking at how the property performs now, you're trying to estimate how it will perform over the next 5, 10, or even 20 years. Gallinelli walks us through the process of creating these projections, showing how you need to factor in all sorts of variables, some predictable, others not so much. First, there are the obvious income sources: rental payments, parking fees, or any other streams of income your property might generate. Gallinelli emphasizes that you need to be conservative when estimating future income. For example, don't assume that you'll always be able to raise the rent by 5% every year, or that you'll never face a vacancy. One of the biggest mistakes novice investors make is being overly optimistic about their income projections. Gallinelli's advice: assume things will go wrong, plan for vacancies, late payments, and tenants moving out. On the expense side, Gallinelli gets even more detailed. It's easy to underestimate your expenses when you're excited about a new deal, but the reality of property management often means dealing with costly repairs, increasing taxes, and the constant need for maintenance. Gallinelli walks us through a sobering example of what happens when you fail to budget for these unexpected costs. Maybe your property seems profitable on paper, but what happens when the roof needs to be replaced or the heating system breaks down? Without cash flow projections that factor in these potential expenses, you're setting yourself up for a rude awakening. But Gallinelli doesn't just leave you to worry about the potential downsides. He explains that cash flow projections are your best defense against unexpected financial hits. By creating a detailed projection model that includes a range of scenarios, from best case to worst case, you can avoid being blindsided. This is where having a thorough understanding of your property's financials really pays off. When you anticipate the worst, you're prepared for anything. What's especially important in this chapter is Gallinelli's focus on being conservative with your estimates. He stresses that it's always better to be pleasantly surprised by better-than-expected performance than to be caught off guard by expenses you didn't plan for. This cautious approach might seem overly pessimistic at first, but it's the hallmark of a successful investor, someone who's ready for both good times and bad. Gallinelli also highlights the importance of regularly revisiting your projections. Real estate markets are dynamic, and so are the expenses and income streams associated with your property. Maybe your property's value increases faster than expected, or maybe a new tax law significantly raises your costs. The key is to stay adaptable. Gallinelli encourages investors to update their projections every year, using fresh data and adjusting for new market realities. In his view, real estate isn't a set-it-and-forget-it investment. It requires ongoing attention, and your cash flow projections should reflect that. By the end of this chapter, you realize that cash flow projections are not just a technical exercise. They're a way of managing risk. When you take the time to map out different scenarios, you're not just protecting yourself from financial surprises. You're empowering yourself to make better, more informed decisions. Gallinelli's approach is all about taking control of your investment, ensuring that you're prepared for whatever the future may hold. Chapter 5: Financing and Leverage: The Power of Debt. With cash flow projections firmly in hand, Gallinelli turns his attention to one of the most powerful and potentially dangerous tools in a real estate investor's toolkit: leverage. When most people hear the word leverage, they think of debt. And while debt often gets a bad rap, in the world of real estate, it's a key component of many successful investment strategies. But as Gallinelli points out, leverage is a double-edged sword. Used wisely, it can multiply your returns. Used recklessly, it can lead to financial disaster. So, what exactly is leverage? In simple terms, it's using other people's money to buy property. This usually means taking out a mortgage to finance a portion of the purchase price. The idea is that by borrowing money, you can control a much larger asset than you could by paying cash. For example, if you have $100,000 in cash, you could buy a $100,000 property outright. But if you use that $100,000 as a 20% down payment, you could control a $500,000 property. The potential returns on that $500,000 property are much greater than what you'd get from a $100,000 property. This is the magic of leverage. But Gallinelli doesn't sugarcoat the risks. While leverage can increase your returns, it also increases your risk. The more debt you take on, the more you owe in monthly mortgage payments, and the more pressure there is to generate positive cash flow. If your property doesn't perform as expected, if you face higher than anticipated expenses or an extended vacancy, you could find yourself in a precarious financial position. Gallinelli walks us through a few scenarios to illustrate the power of leverage. In one example, he shows how a modest increase in property value can result in a substantial return on investment, thanks to the use of debt. But in another scenario, he shows what happens when things go wrong. Imagine a situation where you've taken on too much debt, and your property's cash flow dries up due to unforeseen repairs or a downturn in the rental market. Suddenly, those monthly mortgage payments become a heavy burden, and you're scrambling to stay afloat. The key to using leverage wisely, Gallinelli explains, is understanding your limits. He advises investors to be cautious about over-leveraging, which means borrowing too much relative to the property's cash flow. A common rule of thumb is to aim for a loan-to-value ratio, LTV, of around 70–80%, meaning you finance 70–80% of the property's purchase price and cover the rest with your own money. This gives you enough of a cushion to absorb any financial shocks without falling into the trap of excessive debt. Gallinelli also delves into the role that interest rates play in determining the cost of leverage. When interest rates are low, borrowing money is cheap, and it makes sense to use leverage to finance real estate purchases. But when interest rates rise, the cost of borrowing increases, and the risk of taking on too much debt becomes greater. Gallinelli encourages investors to keep a close eye on interest rate trends and to consider locking in fixed-rate mortgages when rates are low, ensuring that your monthly payments remain predictable over the long term. What makes this chapter particularly compelling is how Gallinelli balances the pros and cons of leverage. He's not advocating for reckless borrowing, but he's also not saying that debt is something to be avoided altogether. Instead, he paints a nuanced picture of how leverage can be a powerful tool when used carefully and responsibly. It's all about striking the right balance between risk and reward. As we move through this chapter, the lesson becomes clear. Leverage can be a game changer for real estate investors, but it requires careful planning and risk management. Gallinelli's advice is to always have a contingency plan. What happens if your property doesn't generate the income you expected? What if you face an extended vacancy or a major repair? By thinking through these scenarios and being conservative in your use of leverage, you can harness the power of debt while minimizing your exposure to risk. Chapter 6. Analyzing Deals: How to Evaluate Opportunities. Now that we've explored the importance of leverage and how it can enhance your real estate strategy, Frank Gallinelli takes us to the heart of successful investing: deal analysis. In this chapter, Gallinelli pulls back the curtain on how seasoned investors evaluate opportunities. It's not about gut feelings or getting caught up in the aesthetics of a property. It's all about the numbers. Analyzing deals is the skill that separates the professional investor from the hobbyist, and Gallinelli emphasizes that mastering this skill is crucial to avoiding bad investments and seizing good ones. Imagine walking into a property that looks perfect on the outside. It's in a great neighborhood, the paint is fresh, and the landscaping is immaculate. You might feel excited and think, this is a great investment. But Gallinelli warns us not to be fooled by appearances. The real question isn't whether the property looks good, it's whether the property works financially. And the only way to answer that question is by diving into the numbers and using cold, hard data to guide your decision. The first step in analyzing any real estate deal is gathering information. Gallinelli stresses that you need to understand every detail about the property's income, expenses, and potential risks. You're not just looking at how much rent the property can generate, you're looking at the entire financial picture. What are the operating expenses? What's the vacancy rate in the area? How much will it cost to maintain the property? Are there any hidden costs, like major repairs that might be needed in the near future? These are the kinds of questions that should be at the forefront of your mind as you evaluate a deal. Gallinelli introduces us to a few key metrics that can help us analyze deals more effectively, starting with cash-on-cash return. This is one of the simplest ways to measure the return on your investment. Cash-on-cash return looks at how much money you're putting into the deal up front, your down payment and closing costs, and compares it to the annual cash flow the property generates. The formula is straightforward: annual cash flow, cash invested, cash-on-cash return. What makes this metric so useful is that it gives you a quick snapshot of how hard your money is working for you. If you're putting down a significant amount of cash but only getting a small return, that's a red flag. But Gallinelli doesn't stop there. He also walks us through more advanced metrics, like the debt coverage ratio, DCR, which is a critical tool for evaluating how well a property's income covers its debt obligations. The DCR is calculated by dividing the property's NOI by its total debt service, the total amount of principal and interest you owe on your mortgage. A DCR of 1.0 means that the property is generating just enough income to cover its debt payments, which is risky because there's no cushion. Most lenders and investors look for a DCR of at least 1.2, meaning the property generates 20% more income than what's needed to cover the debt. This gives you some breathing room in case your income dips or expenses rise. Gallinelli's lesson here is simple but powerful. Numbers don't lie. You might fall in love with a property's location or its aesthetic appeal, but if the numbers don't add up, it's not a good investment. He urges investors to rely on data, not emotions, when analyzing deals. This might seem obvious, but it's easy to get swept up in the excitement of a potential deal and overlook the financial realities. One of the standout lessons in this chapter is the importance of creating a thorough pro forma, a detailed financial projection for the property that accounts for both income and expenses over time. Gallinelli explains that a pro forma isn't just a static document you prepare before buying a property. It's a living, breathing tool that you revisit regularly to ensure your property is performing as expected. The pro forma should include conservative estimates for rental income, vacancy rates, property taxes, insurance, maintenance, and any other relevant costs. By keeping your projections realistic, you can avoid unpleasant surprises down the road. Gallinelli also stresses the importance of having a plan for different scenarios. What happens if the rental market softens and you can't raise the rent as much as you anticipated? What if your operating expenses increase faster than expected? Smart investors prepare for these possibilities by building multiple scenarios into their deal analysis. Gallinelli walks us through the process of creating both a best-case and a worst-case scenario, allowing you to see how the deal holds up under different conditions. If the numbers still work in the worst-case scenario, that's a good sign you're making a solid investment. In addition to analyzing the property's financials, Gallinelli reminds us that market conditions are just as important. A property might look great on paper, but if it's located in a declining market or an area with low demand for rentals, your investment could still underperform. He encourages investors to do thorough market research, looking at trends in population growth, job creation, and economic stability. If a market is shrinking or facing economic challenges, that could signal trouble for your property's long-term performance. Ultimately, Gallinelli's message is clear. The numbers are your guide. Successful real estate investors know how to evaluate opportunities using data and financial metrics. They don't rely on gut instincts or wishful thinking. They rely on a careful analysis of the facts. By mastering the art of deal analysis, you can avoid costly mistakes and make investments that generate consistent, positive cash flow. Gallinelli ends this chapter by encouraging investors to stay disciplined. It's easy to get excited about a deal and overlook the warning signs, but that's exactly when you need to be the most careful. By sticking to a systematic approach and focusing on the numbers, you can protect yourself from bad investments and set yourself up for long-term success in real estate.
Chapter 7. Risk and Return. Balancing the Two.
As we move further into Frank Gallinelli's world of real estate investing, the conversation inevitably turns to one of the most fundamental principles of finance: the balance between risk and return. Every investment carries some level of risk, but understanding how to manage and balance that risk is what separates smart investors from those who get overwhelmed or make reckless decisions. In this chapter, Gallinelli explores the types of risks that real estate investors face and how to ensure that the potential return justifies the risks you're taking on. Gallinelli begins by reminding us that no investment is without risk. Even real estate, which many consider one of the more stable investment classes, has its share of uncertainties. The first type of risk he introduces is market risk, which refers to the possibility that market conditions could change and negatively affect your investment. For instance, a booming rental market today could turn cold tomorrow if there's a local economic downturn, an oversupply of rental units, or a shift in population dynamics. If the local economy weakens and tenants are harder to find, your cash flow might dwindle and your property's value could drop. Next, Gallinelli talks about property-specific risks. Every property has unique factors that can introduce risk. Maybe the building is old and requires significant maintenance, or perhaps it's located in an area prone to flooding or other environmental hazards. These are risks that relate specifically to the property itself and its physical condition. While market risk is something you can't control, property-specific risks can often be mitigated by doing thorough due diligence and understanding the property's history and maintenance needs before you make the purchase. One of the most crucial aspects of balancing risk and return is knowing how to assess and weigh these risks against the potential return on investment. Gallinelli introduces the idea of risk-adjusted return, which helps investors compare different investment opportunities, not just in terms of potential profits, but also in terms of the risk they carry. A higher return might sound enticing, but if it comes with a higher level of risk, you need to ask yourself whether that return is worth the potential downsides. Gallinelli gives an example of two properties, one in a high-demand, low-risk area that offers a steady but modest return, and another in a less desirable neighborhood that offers a much higher return, but with more volatility. Understanding your own risk tolerance and financial goals will help you decide which investment is right for you. In this chapter, Gallinelli also introduces another key concept: diversification. If you've ever heard the saying, "Don't put all your eggs in one basket," you'll understand the idea behind diversification. In real estate investing, diversification means spreading your investments across different properties, types of real estate, and even different geographic locations. By doing this, you can reduce the overall risk in your portfolio. For example, if you own properties in multiple cities, a downturn in one market won't completely sink your investment portfolio. Or, if you own both residential and commercial properties, a slowdown in the residential market might be offset by strong performance in the commercial sector. Gallinelli emphasizes that diversification is one of the most effective ways to manage risk while still aiming for strong returns. But even with diversification, risk is always present. Gallinelli introduces another layer to the risk discussion: liquidity risk. Real estate is often considered a liquid asset because it can't be easily converted into cash. If you need to sell a property quickly, especially in a down market, you might have to accept a lower price than you'd like, or you might struggle to find a buyer at all. This lack of liquidity means that real estate investments often require a longer time horizon, and investors need to be prepared to hold on to their properties through ups and downs in the market. If you're in a situation where you need cash fast, real estate might not be able to deliver the liquidity you need. One of Gallinelli's key messages in this chapter is that risk and return are two sides of the same coin. There's no such thing as a risk-free return, and higher returns almost always come with higher risks. The challenge for investors is finding the right balance. Are you willing to accept a lower return in exchange for more stability and less risk? Or are you comfortable taking on more risk in pursuit of higher returns? Gallinelli doesn't prescribe a one-size-fits-all answer. He encourages each investor to assess their own risk tolerance and financial goals. Gallinelli also introduces the idea of stress testing your investment. This means asking the tough what-if questions before you commit to a deal. What if the vacancy rate increases? What if rents don't rise as fast as you anticipated? What if property taxes go up? By running different scenarios and imagining the worst-case situations, you can better prepare yourself for potential setbacks and ensure that your investment can still generate positive cash flow even under challenging conditions. Gallinelli advises that if a deal doesn't hold up under stress testing, it's not worth pursuing. Another key takeaway from this chapter is Gallinelli's focus on staying realistic about returns. While it's easy to get excited about a deal that promises double-digit returns, Gallinelli urges caution. Often, deals that seem too good to be true come with hidden risks or assumptions that are overly optimistic. Maybe the projected rental income is based on the assumption that the property will be fully rented all the time, or maybe the renovation costs are underestimated. Gallinelli stresses the importance of scrutinizing every assumption and making sure that you're not just chasing high returns without fully understanding the risks involved. Toward the end of the chapter, Gallinelli touches on the psychological aspect of risk. He acknowledges that it's natural to feel anxious about taking risks, especially when it comes to large financial investments. But he also reminds us that without some level of risk, there's no potential for reward. The key is to manage risk intelligently and to make decisions based on data and analysis, rather than fear or emotion. Gallinelli's approach to risk is methodical and measured, and he encourages investors to follow the same path. Ultimately, this chapter teaches us that risk is an inherent part of real estate investing, but it's not something to be feared if managed properly. By understanding the different types of risk, market risk, property-specific risk, liquidity risk, and using tools like diversification, stress testing, and risk-adjusted returns, investors can make informed decisions that balance the potential for profit with the realities of risk. Gallinelli's message is clear. Embrace risk, but do it with your eyes wide open. Chapter 8. The Art of Due Diligence. Frank Gallinelli's journey into real estate investing takes a crucial turn in this chapter as he focuses on a process that every investor must master: due diligence. If deal analysis is about evaluating a property based on its financial performance, then due diligence is about digging deeper, peeling back the layers to reveal any hidden risks, issues, or opportunities that may not be immediately obvious. In this chapter, Gallinelli emphasizes the importance of being thorough, methodical, and above all, patient when performing due diligence. This step is where successful investors protect themselves from future headaches, and it's the ultimate safeguard against buyer's remorse. Imagine this scenario. You've found what seems to be the perfect property. The location is great, the price is within your budget, and on the surface, it appears to be a strong investment. It's tempting to rush through the buying process and close the deal before someone else snaps it up. But Gallinelli warns that this is precisely when you need to slow down and take a closer look. Due diligence is about making sure that what you think you're buying is what you're actually getting. This means scrutinizing every detail, financial, legal, and physical, before you commit. The first area Gallinelli advises investors to examine during due diligence is the financial history of the property. He explains that it's not enough to rely on projections or promises from the seller or broker. You need to verify the actual numbers. This includes reviewing rent rolls, tenant leases, and expense reports. Is the rental income steady, or are there frequent vacancies? Are tenants on long-term leases, or do they tend to move out after a short time? Gallinelli stresses that you should request at least 2 years of financial statements to see a clear picture of the property's performance. If the numbers don't add up, or if the seller is reluctant to provide detailed financials, that's a red flag. One of the key aspects Gallinelli highlights in this financial review is the concept of verifiable income. He warns against relying on speculative income, which might include projected rents that the property hasn't yet achieved. For example, a seller might tell you that they plan to increase the rent by 10% next year, but if that increase hasn't happened yet, you can't count it as guaranteed income. As Gallinelli explains, real estate investing is about dealing with facts, not speculation. He advises you to base your evaluation on the current income and treat any potential increases as a bonus, not a guarantee. Next, Gallinelli turns our attention to operating expenses. It's easy to overlook some expenses during the initial excitement of a deal, but this can lead to nasty surprises later on. Gallinelli walks us through the importance of verifying all operating costs, including property management fees, insurance, utilities, and maintenance. He emphasizes that you should get estimates from third parties rather than relying on the seller's figures to ensure that you're working with realistic numbers. If you discover that expenses have been underestimated, this could dramatically affect the property's profitability. After the financial review, Gallinelli moves on to the legal aspects of due diligence. This includes making sure that the property is free of any legal encumbrances that could cause problems down the road. For instance, are there any liens against the property? Are there disputes with tenants or unresolved lawsuits? Gallinelli advises working closely with a real estate attorney to review the title and ensure that there are no legal issues that could interfere with your ownership. He also recommends checking zoning regulations and permits to make sure that the property is being used legally and that there are no restrictions on future development or renovation plans. One of the more nuanced areas of legal due diligence involves tenant leases. Gallinelli explains that understanding the terms of existing leases is critical because they directly affect the cash flow of the property. For example, a tenant might be on a lease with below-market rent that can't be increased for several more years, or there might be a clause allowing tenants to break their lease without penalty. These kinds of details can have a huge impact on your income, and Gallinelli advises that you carefully review every lease before closing the deal. If there are tenants in place, you'll want to know how reliable they are, how long they've been there, and whether they're likely to stay. After covering financial and legal due diligence, Gallinelli turns to the physical condition of the property. This is where many investors stumble, especially if they fall in love with the aesthetic appeal of a property and neglect to thoroughly inspect its physical state. Gallinelli stresses that you should always hire a professional inspector to evaluate the building's condition. This inspection should cover the major systems, plumbing, electrical, HVAC, as well as the roof, foundation, and overall structural integrity of the building. Gallinelli tells us that no matter how good a property looks on the surface, there are often hidden problems that can lead to significant expenses down the line. Maybe the roof is nearing the end of its lifespan, or perhaps there are signs of water damage that could lead to mold or structural issues. A thorough inspection will reveal these potential problems, allowing you to either renegotiate the price or walk away from the deal altogether. Gallinelli also introduces the concept of environmental due diligence. This is particularly important if the property is located in an area with a history of environmental issues, such as contamination from industrial activity or proximity to hazardous materials. While this might not be a concern for every property, Gallinelli advises that you check local environmental records and, if necessary, hire an environmental consultant to assess the property for any potential risks. The last thing you want is to purchase a property only to discover that it's contaminated and requires expensive remediation. What makes Gallinelli's approach to due diligence so valuable is that it's not just about protecting yourself from bad deals. It's about empowering you to make informed decisions. By thoroughly examining every aspect of a property, financial, legal, and physical, you're giving yourself the best chance to succeed as an investor. You're not just relying on hope or luck. You're using data, facts, and expert advice to ensure that you're making a sound investment. Toward the end of the chapter, Gallinelli reminds us that due diligence is not something to rush through. It's a painstaking process, but it's one that pays off in the long run. As an investor, your goal is to minimize risk and maximize return, and due diligence is your first line of defense against making a costly mistake. Gallinelli encourages investors to be patient, even if it means walking away from a deal that initially seemed promising. In his view, it's better to lose a deal than to buy a property that turns into a financial drain. In conclusion, Gallinelli's message is clear. Due diligence is not optional, it's essential. Whether you're a seasoned investor or just starting out, this process will save you from financial pitfalls and help you uncover opportunities that others might overlook. The art of due diligence is about being thorough, asking the right questions, and verifying every detail. It's a skill that, once mastered, will serve you well in every real estate investment you make. Chapter 9. Exit Strategies. Planning for the Future. In this chapter, Frank Gallinelli brings us to an often overlooked part of real estate investing, the exit strategy. While many investors focus solely on acquiring and managing properties, Gallinelli stresses that thinking about how and when you'll exit the investment is just as important. A well-planned exit strategy ensures that you can maximize profits, minimize taxes, and avoid unnecessary risks when it's time to sell or transition your real estate assets. Gallinelli begins by reminding us that every investment should be made with an exit strategy in mind. It might sound counterintuitive to think about selling before you've even bought a property, but the truth is, knowing how and when you'll exit gives you a clearer sense of direction throughout your investment journey. Without a plan, you risk being caught off guard when market conditions change or when you need to sell for personal or financial reasons. So, how do you plan for something that might be years or even decades away? Gallinelli walks us through several different exit strategies, each designed to align with different goals and circumstances. One of the most common exit strategies Gallinelli introduces is simply selling the property. This seems straightforward: buy low, sell high. But Gallinelli shows that timing the sale is critical. The real estate market is cyclical, with periods of expansion and contraction. Selling in a down market can mean taking a significant loss, so understanding market trends and being patient is essential. Gallinelli advises investors to keep an eye on the local economy, job growth, and housing demand to determine the best time to sell. He also highlights that selling isn't always about waiting for the market to peak. It could be about seizing an opportunity when the property has appreciated enough, or when you've achieved your financial goals. But selling a property outright isn't the only option. Another strategy Gallinelli explores is refinancing. This can be a powerful way to pull equity out of a property without selling it. Over time, as property values increase and you pay down the mortgage, you build equity in the property. By refinancing, you can borrow against that equity and use the cash to invest in new properties or make improvements to your existing portfolio. Gallinelli explains that refinancing can be a great way to continue growing your real estate business without having to sell and pay capital gains taxes. However, he also warns that refinancing comes with its own risks. Taking on more debt increases your monthly payments, so you need to ensure that the property's cash flow can comfortably cover the new loan terms. Gallinelli then introduces a more tax-efficient exit strategy, the 1031 exchange. For those unfamiliar, a 1031 exchange allows investors to defer paying capital gains taxes when they sell a property, as long as they reinvest the proceeds into another like-kind property. The beauty of the 1031 exchange is that it enables investors to grow their portfolio without the immediate tax burden that typically comes with selling a property. Gallinelli explains the rules and restrictions of a 1031 exchange in detail. You need to identify the new property within 45 days of the sale, and the transaction must be completed within 180 days. Additionally, both the property you sell and the property you buy must be for investment purposes. This strategy allows you to keep building wealth in real estate while deferring taxes indefinitely. As long as you continue exchanging properties, you won't have to pay capital gains tax until you sell without reinvesting, or potentially never if you plan carefully. While a 1031 exchange can be highly advantageous, Gallinelli also notes that it's not without its challenges. The biggest hurdle is finding a replacement property within the tight time frame, which can be stressful. If you're unable to secure a new property in time, you'll have to pay the capital gains tax on the sale, defeating the purpose of the exchange. Gallinelli advises that before initiating a 1031 exchange, you should already have potential replacement properties in mind to avoid a last-minute scramble. Another option Gallinelli explores is holding the property long-term and passing it on to your heirs. This strategy is often referred to as buy and hold, and involves keeping the property indefinitely to generate ongoing cash flow. For many investors, this is an attractive option because it allows them to enjoy the steady income from rental properties while potentially avoiding taxes through estate planning. When you hold a property long-term, you can also take advantage of market appreciation, using the property's increasing value as a way to build wealth over time. Gallinelli emphasizes that a key advantage of the buy and hold strategy is the stepped-up basis rule, which can greatly reduce the tax burden for your heirs. When you pass on a property to your beneficiaries, the property's value is stepped up to its current market value at the time of your death, meaning that any appreciation that occurred during your ownership is not subject to capital gains tax. This makes buy and hold an appealing strategy for those looking to create generational wealth through real estate. However, Gallinelli cautions that this strategy requires careful estate planning, and he advises investors to consult with tax professionals to ensure their heirs are fully prepared for the responsibilities of property ownership. In addition to these common strategies, Gallinelli also discusses partial sales as an exit option. For example, you might sell a portion of your interest in a property to a partner or an investment group while retaining some ownership. This allows you to liquidate part of your investment while still benefiting from any future appreciation or cash flow. Gallinelli explains that partial sales can be a good option for investors who need liquidity but don't want to completely exit the property. At this point in the chapter, Gallinelli brings attention to the importance of adapting your exit strategy based on changing circumstances. Maybe your personal financial goals shift over time, or perhaps the market conditions aren't favorable for a sale when you initially planned. The ability to remain flexible and adjust your exit plan as needed is a key trait of successful real estate investors. Gallinelli encourages investors to regularly revisit their exit strategies and make adjustments based on market trends, their financial situation, and their long-term goals. Gallinelli closes the chapter by reminding us that having a well-thought-out exit strategy not only provides a clear path forward, but also gives you peace of mind. Knowing how you'll exit an investment allows you to focus on maximizing your property's performance in the meantime, without worrying about what will happen when it's time to sell. Whether you plan to sell, refinance, exchange, or hold long-term, having a strategy in place ensures that you're in control of your investment's future. In summary, Gallinelli makes it clear that an exit strategy is not an afterthought. It's an integral part of the investment process. As investors, we need to be proactive about planning how we'll eventually exit each deal. The right strategy depends on your goals, risk tolerance, and the market conditions at the time. But no matter what, you should always have a plan in place. Whether you're just starting out in real estate or you're a seasoned investor, this chapter underscores the importance of thinking ahead and ensuring that you're always prepared for the next step in your investment journey. Chapter 10. Building a Portfolio, Scaling Up Your Investments. As we reach the final chapter of Frank Gallinelli's What Every Real Estate Investor Needs to Know About Cash Flow, the focus shifts from individual properties to the broader picture of building and managing a real estate portfolio. By now, you've learned how to analyze deals, manage cash flow, and plan your exit strategies. But Gallinelli makes it clear that the ultimate goal for many real estate investors is to scale up their operations and create a diversified portfolio of properties. This chapter is all about how to make that transition, how to go from owning a single property to managing multiple, all while maximizing returns and minimizing risk. Gallinelli starts by explaining that, for many investors, the first property is often the hardest. It's where you learn the ropes, make mistakes, and begin to understand how the real estate business works. But once you've successfully managed one property, the question naturally becomes, what's next? How do you take the knowledge and experience you've gained and apply it on a larger scale? Gallinelli emphasizes that building a real estate portfolio isn't just about acquiring more properties. It's about making sure that each addition strengthens your overall investment strategy. The key to scaling up, Gallinelli explains, is strategic growth. It's not about buying properties for the sake of expanding. It's about choosing the right properties that fit into your long-term goals. This requires you to think carefully about what types of properties you want in your portfolio. Are you focused on residential rentals, or are you interested in diversifying into commercial or industrial properties? Maybe you're considering vacation rentals or multifamily units. Each type of property comes with its own set of challenges and benefits, and Gallinelli encourages investors to evaluate how each new acquisition complements their existing assets. One of the most important concepts Gallinelli introduces in this chapter is portfolio diversification. We've all heard the saying, Don't put all your eggs in one basket. And this principle is especially true in real estate investing. Diversification means spreading your investments across different types of properties and geographic locations to reduce your overall risk. For example, if all of your properties are concentrated in one city and the local economy takes a hit, your entire portfolio could suffer. But if you own properties in multiple cities or even different states, you're better protected from regional downturns. Diversification can also apply to property types. Gallinelli explains that owning a mix of residential, commercial, and industrial properties can provide a more stable income stream. For example, if the residential rental market is down, but your commercial properties are thriving, the losses in one area can be offset by gains in another. By diversifying both geographically and across property types, you can create a portfolio that's resilient in the face of economic fluctuations. Gallinelli also dives into the topic of leverage once again, this time in the context of scaling up. While leverage was discussed earlier as a tool for individual property purchases, it becomes even more important when you're trying to grow a portfolio. Using leverage wisely can allow you to acquire more properties without tying up all of your own capital. However, Gallinelli reiterates the importance of being cautious with debt. While leverage can magnify returns, it can also magnify risks, especially when managing multiple properties. Gallinelli's advice is to always ensure that your cash flow is strong enough to cover the debt on all of your properties, even in the worst-case scenarios. One of the strategies Gallinelli suggests for scaling up your portfolio is reinvesting your profits. As your properties generate positive cash flow, you can use those profits to purchase new properties. This creates a compounding effect, where the income from each property helps fuel the acquisition of the next. Over time, this reinvestment strategy can lead to significant growth. Gallinelli reminds us that the power of compounding is one of the most powerful forces in real estate investing. By consistently reinvesting your profits, you can exponentially increase the size and value of your portfolio. But Gallinelli is quick to point out that scaling up doesn't just mean buying more properties, it also means improving the properties you already own. Sometimes the best investment you can make is in your existing assets. By upgrading and maintaining your properties, you can increase their value and attract higher-paying tenants. Gallinelli gives examples of investors who have focused on renovation and improvements, turning underperforming properties into high cash flow assets. Whether it's a simple cosmetic upgrade or a major renovation, improving your current properties can be a smart way to grow your portfolio without taking on the risks associated with new acquisitions. Another critical aspect of scaling up is property management. As your portfolio grows, managing multiple properties becomes more complex. Gallinelli stresses that effective property management is essential to maintaining the profitability of your portfolio. For smaller portfolios, many investors choose to manage their properties themselves. But as you scale up, this becomes increasingly difficult. Gallinelli advises investors to consider hiring a professional property management company when the workload becomes too much to handle on their own. A good property manager can handle everything from tenant relations to maintenance and repairs, allowing you to focus on growing your portfolio rather than getting bogged down in day-to-day operations. Gallinelli also touches on the importance of financial management when scaling up. As your portfolio grows, so do your financial responsibilities. Keeping track of income, expenses, taxes, and loan payments across multiple properties can be a challenge. Gallinelli encourages investors to use financial software or hire an accountant to help manage the financial side of their portfolio. This ensures that you're staying on top of your cash flow, taxes, and compliance with local regulations. By keeping your finances organized, you'll be in a better position to make informed decisions about future investments. As we approach the end of the chapter, Gallinelli turns to the long-term vision of real estate investing. For many investors, the goal of building a portfolio is to create passive income, a steady stream of income that requires little day-to-day involvement. But Gallinelli cautions that reaching this point takes time, patience, and careful planning. Scaling up too quickly, taking on too much debt, or neglecting property management can lead to burnout or financial trouble. The key is to grow at a pace that's sustainable and aligned with your long-term financial goals. Gallinelli concludes by reminding us that real estate investing is a marathon, not a sprint. Building a successful portfolio takes time, and there will inevitably be bumps along the way. But by focusing on cash flow, diversification, leverage, and smart management, you can build a portfolio that generates long-term wealth and financial independence. Gallinelli leaves us with the reassurance that real estate offers one of the most reliable paths to wealth, as long as you're willing to put in the work, stay disciplined, and make data-driven decisions. In the end, the message is clear. Real estate isn't just about buying properties. It's about building a strategy, executing it with precision, and continually improving along the way. With the right approach, you can scale up your investments and create a portfolio that supports your financial goals for decades to come.